Assalamu Alaikum everyone, welcome back to the channel. In today's video we're going to look at two UK stocks that I believe are undervalued at the moment and will be a great addition to any growth portfolio. These companies have two things in common, and that's the fact they both are globally well known and have a very good dividend yield. This is my overall portfolio, as you can see on this on the screen, and as you can see at the moment between the two accounts that I've got about $37,000 in those two accounts. You can see the yield's about 2.3. This is just my dividend portfolios. I've also got a growth portfolio that I normally share. If you are new to the channel, please subscribe, let me know what you think about some of the videos, and if you have any questions, always leave your comments and inshallah I will try to answer your questions. Right, so the first company that we're looking at today is Unilever. I like this company for a few reasons. One is the company is a reliable dividend payer with excellent dividend growth track record. Over the last 70 years, Unilever has grown its payout by around 8% per year. One of the other reasons is that basically it has a long-term growth potential, with more than 50% of its revenue coming from emerging markets. Now that is really important to me, and it should be important to you if you are investing in the stock market, because when we invest in the stock markets, what we tend to do is we invest in companies that we know, maybe that is in our own countries, whatever, but obviously you need a companies that give you exposure basically to the rest of the world. And if the 50% of the revenue is coming from emerging markets, that's excellent. That's what you want to see. And that, what I mean by that is, and some of those basically countries include countries like China, India, Brazil. These are emerging markets. These are markets that are very hot at the moment and doing really great job with their markets and so on. So this just basically gives you exposure to the rest of the world. This company sells loads of different products. I'm sure you've seen it. I love Ben & Jerry's. I've always been, love that kind of stuff. So but they have all this kind of products. If you ever walk inside a bathroom, have a look around at some of the products that you've got, you probably have something from Unilever in your stock somewhere. All right, so let's have a look at the numbers at the moment. The company is obviously in the consumer staples. They currently trading £42. They've been down for a while in my portfolio, and I'll show you in a second. They currently have a trailing PE of 23, so it's slightly high. Their market cap is probably one of the biggest in the UK at the moment, and that's $112 billion company. Like I said in the introduction, they actually pay very good dividends, so that's 3.4 yield. They've been paying this basically last they've been growing basically this about 3%, which is quite low. Okay, now I couldn't find any reliable information, but the only one I found was that said 70 years of growth, but I'm not sure how consistent that has been, so I just put there 1 year, but I'm sure you can find that information if you go to HL or other companies, because the problem with this sort of a company is because they're worldwide company, they actually do have trading basically in different stock markets, and there's a different information available. But their payout ratio is 77%. We're looking for about 61%. Their dividend basically safety, according to simply Dividend Safety website, basically is about 75%, which is really good. I say basically too many times, haven't I? So free cash flow, you got about almost 7%. Like I said before, the 52-week range has been crazy because it's been ranged from 37 to 49, so it's been up and down in between. So I think I started buying when it was in the 40s, and then it went down, and then it went back up, and now it's been better in the last few weeks. The beta very, very slow, very nice. Anything below 1 here means the stock's not volatile. The margins, profit margins, is not what we're looking for, but we'll take that because the equity is actually, return on equity is quite nice, right? And then you get in actually 3%, almost 4% dividend yield as well on the top of that. So according to Simply Wall Street, is currently undervalued, but not by much. So if you were to buy this company and you were really interested and you've done your due diligence, you've done your research, and you're not relying on this kind of quick information, I will say maybe wait until it goes maybe below 40, And if you can get below 40, I think then that's value for money, because with this sort of companies, you need to have margin of safety. Even though their beta is quite small and they're not too volatile, whatever, and you're getting very good dividend yield, you still need to be safe. Okay, so at the moment it's basically is ranked by Yahoo Finance, and obviously is undervalued. So maybe wait until, if you're willing to wait, maybe 39ish, maybe that will be a good time to buy more. The next company that we're looking at is Rio Tinto. Rio Tinto is a mining company. Mainly they do iron ore. So one of the things that you really need to watch out is when the price of iron ore, for example, goes down, the stock is very volatile. It really is quite volatile, so you have to be careful. If you buy in this kind of basically companies, you need to know basically when certain commodities go down, they will be going down too with it as well. So if you're interested, have a look at a bit more, and in the company details, find out a bit more. They have actually their investors website, investor section of their website, they've got some great numbers that they've listed in terms of cash flow and things like that, the debt. So they've got nicely laid out information here that gives you everything and every sector. So if you're really interested, I've read every single one of these things, but I don't want to bore you to death. So it's important that you look at these kind of things to make your final decisions before you start investing in the company. So Rio Tinto, again, is a materials company. Like I said, it's a mining company, trading about £60 per share at the moment. I bought around this time, I think, and I'm in the green at the moment, but we'll see how long that lasts, because it's been actually going down in the last couple of days. PE very, very low. Again, the first company that we looked at, the PE ratio was about 23. Now when you look at this PE of 14, less than 15, which that's amazing, or for a company that is almost a $95 billion market cap. Dividend almost 6%, almost 6% dividend yield, and for the last 5-year growth rate has been 17%. Again, I wrote one here because I'm not sure, there's loads of different information, because the stock trades in different stocks exchange, they all have different things. So I just put here 1 year, so you need to find out a bit more information if you're interested. But when it comes to payout ratio, here is only 64%, and the dividend safety, according to Simply Safe Dividend website, which is this website I'm using here, okay, it's actually 47. It's probably one of the lowest that I've got, and one of the reasons for this is because they have cut their dividends previously, so anything can happen. And again, if the commodities are going down and the mining is not going well, or iron ore prices go down, then the company might not make enough profit, then they might actually cut their dividend. But they have healthy £7 billion pounds in the bank for free cash flow to pay off all these dividends. So I'm not sure what's going on. Maybe this is for the UK and the US based version of it, I don't know. It will actually be interesting to find out a bit more information. Now you can see from the 52-week range, £42 were the lowest and 67 was actually the highest. I wish I knew this company, or basically knew more about it around this time, because that would have been great entry for this company. Basis again it's not bad, so it's about 0.82, less than 1. That's really good. Profit margin of almost 22%, and then return on equity of almost 21.4%. Now currently, according to Simply Wall Street, is actually undervalued. Again, really healthy undervalued. It's not like on the edge like when we looked at Unilever. Okay, almost 3% here. This is about 17%. So they must think is actually really, really undervalued. And according to Yahoo Finance, is actually a buy at the moment. Now, this is a great company. If you're based in the UK and you're looking for long-term investments, I think I would prefer Unilever out of the two. And the reason for that is because their products is actually everywhere. These products, basically, you can, anytime you go to a supermarket, you're probably walking away with one of these products. Okay. And again, because of the consumer staples, because it's essentials, people will just go and buy it. Like literally with the Tresemme, whatever these products are, literally our wives just go to these shops and buy Dove stuff without even thinking about it. We do as well. Like, in my household, there's so many products that this actually company produces. So they are better in terms of, I would put a lot more money in this company than actually Rio Tinto, because Rio Tinto is actually quite volatile. It all depends on how commodities are trading on that point and so on. So, but that was just quick overview. The other things that you need to do before you actually make a decision is obviously look at the finance side of things. So go to Yahoo, type UL for example for the US based version of this company, click financials, go to there, first of all, the income section, which tells you all their revenue, it tells you all the costs, and then basically gross profit. Once you're done with that, have a look at the balance sheet. So if they have debt and things like that, so look at their total assets against total liabilities. So 50 billion, again this is in euros, and then you've got 67 billion euros as well there. Again, have a look at their free cash flow. So this is Unilever only. When you look at that, this almost about 8%, $8 billion or 8 billion euros. Now that's the kind of thing I would do. I will also go into the finance side of things, read about it in the last 5 years, find out information for almost the last 10 years, and then make your decisions based on what you've seen, what you've read. The other things that I also advise you to do is look at statistics. Okay, look at the analysis, what the basically analysts are saying for the next, what they're predicting the company to make in the next 5 years or whatever. So that sort of a thing will really help you. I hope you enjoyed the video. If you're new here, that was kind of quick overview of some of the companies I've invested. So if you're new here, please subscribe, like, let me know what you think. And inshallah, if you have any questions regarding this, let me know. So quickly, I'm going to show you the fact that I own these companies, just to be transparent. So I own 30 shares of Unilever, and at the moment that gives me about £45, okay, of dividend per year. Same thing, Rio Tinto, I own 7 shares, and at the moment that gives me about £20 of dividend per year. Okay, so again, that's transparent. That's just my overall portfolio. If you like what you've seen today and you've found value in this, please like, subscribe, let me know. Thank you very much for watching. Take care. Assalamu Alaikum.